Alright, now let's move to the right side of the screen. This is still a bull call debit spread, but notice how the strikes are different. Here I'm buying the $110 call and selling the $115 call, both expiring January 17, 2026. The total net debit is $150 per contract, so that means my maximum loss is $150 and my maximum profit is $350 on this trade. My break-even price sitting at 111.50. This one is a lower delta spread. The overall delta is about plus 0.20 compared to the higher delta version that we looked at earlier of 0.50. That means this trade moves more slowly with the stock. For every $1 movement in the underlying, this spread gains or loses 0.50 per share or 50 cents per share. So for every $1 of the underlying moving, this spread moves 0.20 or 20 cents per share. So it's a lighter, less aggressive position. You can think of this one as a more conservative version. Smaller initial cost, lower delta, but also a smaller probability of finishing in the money. That's because of where it's positioned. The spread starts out of the money. The stock has to move above 111.50 just to break even and past 115 to reach max profit. That's the balance. Higher delta gives you more certainty and faster response, while lower delta gives you more efficiency and smaller upfront risk. The probability of finishing above break even in this sub is usually around 30 to 40%, depending on volatility and time, theta. The probability of hitting full profit at $115 is smaller, typically in that 20 to 25%, matching up pretty closely with the delta, like I said, with some variance with theta and volume as well, Vega. So you are less likely to win, but if you do, your reward to risk ratio improves. You're risking 150 to make 350 compared to risking 200 to make $300 on the higher delta version. That's the balance. A higher delta gives you more certainty and a faster response, while lower delta gives you more efficiency and a better reward for your risk. And the cool part about this, you can adjust delta yourself by moving your strikes farther out of the money, like this example here. You lower your delta and you lower your debit, and you shift your break even higher. And moving your strikes closer to the current stock price, your delta will rise and the spread is going to cost more, but your break even is also going to move lower. So these are the same spread structures, just two different types of aggressiveness. Now let's bring in IV, implied volatility. The Vega on this spread is about plus 0.03, meaning for every 1% rise in volatility, this spread gains roughly $3 in value per contract. That means debit spreads like this one benefit slightly when volume surges happen or volume increases in general. But the key thing to understand when you enter, you generally want to open debit spreads when IV is low because options are cheaper. If you open when IV is already high and it drops later, your spread can lose value even if price doesn't move months. So IV doesn't decide direction, but it is a timing tool, and it does adjust how much premium you're paying up front and how your position can react after entry. So simply, delta is how fast your trade moves, probability is how likely you finish above break even, and IV is helping decide how much you are paying for that specific contract. So together these three, delta, probability, and IV, are what turn a simple spread into a calculated execution and or position setup. This 110, 115 example shows perfectly. Cheaper entry, lower delta, lower probability, but stronger reward to risk. It's not worse or better, it's just tuned differently, and that's exactly what gives you control as a trader and how to use vertical spreads for different scenarios. Now here's a quick theta summary for both debit spreads. For the left spread, the higher delta, the 100-105 contract, this spread has a slightly higher theta, around 0.03, which means you lose about $3 a day per contract if price and volatility are staying flat. Because it's closer to the money, it carries more premium and decays a bit faster. But if the stock moves up quickly, delta acceleration easily outruns that small daily decay. For the right spread, 110 to 115, this one has a smaller theta, about 0.01, so time decay is much slower, roughly $1 per day. Since it's farther out of the money and cheaper, less value is eroding per day. Still, time is working against you, so you want the move to happen sooner rather than later. So overall, theta is negative for debit spreads, but closer to the money positions, the theta is decaying faster, whereas out of the money positions, theta is decaying far slower. And theta does not have the same effect as it does with single leg calls, but it is still something to keep an eye out and a way to decrease your cost potentially. Now, just to touch on gamma real quick, gamma measures how fast your delta changes as the stock moves. In debit spreads like these, gamma is pretty small because the long and short legs bounce each other out. So as price moves up, delta increases a little bit, which helps the spread gain value faster, but it's not dramatic. You'll mostly feel gamma in options that are not spreads. Still, it's good to remember a little positive gamma means your delta grows as the trade moves in your favor. So gamma does not matter too much. Your delta matters significantly. Your theta matters some, and Vega also matters some. Now to close out, we're going to quick show a couple examples with the stock price at 107 and the stock price also at 117 for both of these positions. So the stock price at 107, your 100-105 bull call spread will be completely in the money. But if you go take a look over on the 110-115 bull call spread, it will be completely out of the money. Now you are risking less. You are risking 150 versus on the 100-105 spread making 300. But now if we take a look over the stock price at 117, your 100-105 will still be completely in the money at 300, whereas now your 110-115 bull call spread will also be max profit at 350. And one important thing to note, with the 110-115 bull call spread, you would more than likely be able to pick up multiple contracts. Or let's say you want to risk $1,000 on the trade. You would be getting 5 contracts with the 100-105 versus getting 6 to 7 contracts with the 110-115 bull call spread to have the same or similar risk profile. So I know I was unpacking a lot in this video. Please go through and listen to it multiple times if you have to, as the Greeks can get somewhat confusing, but you can alter Greeks based on your position. Essentially, what is creating these Greeks, how you're getting these Greek values for each position, is the Greeks from the buy minus the Greeks from the sell. So let's say your buy has a delta of 1 and your sell has a delta of minus 0.50, you would be sitting with a Greek of 0.50 delta for this 100-105 bull call. Same with the buying the 110 and selling the 115. The Greeks are the outcome of these two positions. these would be your net Greeks. So you can alter your Greeks based on your position. You can alter your net debit based on how much you're buying the call for and selling the call for, as well as altering your max profit. So depending on the underlying stock and what you think it's going to do, you can select the corresponding or correct option positions or spreads to enter the trade. So that's all we have here for today, guys. This is the debit spreads. We've been getting some questions about the vertical spreads. This is in the vertical spread category. There are 4 main types of vertical spreads: 2 debit spreads and 2 credit spreads. I'll see you guys next time on Mitchell Markets, where we are going to be going over the bear credit and the bull credit spreads next. And at that point, we'll have the main essentials and a good deep dive into vertical spreads. Thank you guys for listening, and I'll see you next time.